This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Since its launch in January 2025, Harvest's HHIS has quickly become the new favorite for Canadian passive income investors. Its biggest draw isn't just that ultra-high and stable monthly distribution, but its ultimate lazy investment logic. It packages the market's most popular stocks into a single ticker. Investors can effortlessly gain indirect exposure to these stocks through HHIS while collecting massive dividends. However, the 2025 report card has been a bit awkward for traditional finance textbooks. HHIS has been out for nearly a year now, and in that time it has performed exceptionally well, even outperforming the Nasdaq 100 index. As we all know, the fate of a covered call strategy is usually to sacrifice upside potential in exchange for cash flow. People always say this strategy caps your gains, so has that actually happened with HHIS? With this question in mind, I dove deep into its underlying structure. HHIS isn't a static index. It's dynamically composed of multiple single-stock covered call ETFs. Theoretically, if any of those individual ETFs miss the mark on their strategy, it could drag HHIS down and cause it to underperform its underlying assets. The reason I wanted to make this video started with an accidental comparison. When I looked at the performance of certain single-stock covered call ETFs versus their actual underlying shares, I noticed some discrepancies, some quite significant. For example, Harvest's NVIDIA ETF, NVHE, performed quite differently compared to the actual NVIDIA stock. This sparked a strong curiosity. If we reconstructed and backtested the actual holdings of HHIS, would it actually underperform its underlying portfolio? Now, that's easier said than done. Because HHIS underwent two major rebalances in 2025, backtesting this dynamic non-standard asset is extremely difficult. To solve this, I found a powerful website, TFSA, which helps us recreate the performance of the actual holdings as accurately as possible. I've placed the link in the description for anyone interested in verifying this themselves. Today, we are going to break the life cycle of HHIS into 3 stages and let the data do the talking. Stage 1, the initial top 10. From its launch on January 16, 2025 to March 30th, the portfolio consisted of 9 core stocks: NVIDIA, Tesla, Microsoft, Amazon, Meta, MicroStrategy, Coinbase, Eli Lilly, and Palantir. Based on these holdings, we built our first underlying stock portfolio in TFSA, which we'll call HHIS1. Stage 2, expansion and leverage upgrade. On March 31, 2025, HHIS expanded. It added Google, Costco, and Netflix, AMD, and Broadcom into the weightings. Most importantly, it swapped out its original crypto-related tickers for 25% leveraged versions: CNYE, Coinbase, and MSTE, MicroStrategy. Based on these changes, I built the second underlying portfolio, HHIS2. Stage 3, full diversification. On October 31, 2025, HHIS added Reddit, RDDY, Robinhood, HODY, SoFi, SOFY, and Circle, CRCY. These 4 stocks make up about 10% of the portfolio. Based on these final holdings, I built the third underlying portfolio, HHIS3. Now, let's get into the specific calculations. I recommend watching the screen closely. In TFSA, I set the initial investment at $10,000. For Stage 1, from January 16th to March 30th, the return for HHIS1 was minus 12.19%. The math is $10,000 times 1 minus 12.19%, which leaves us with $8,780.86. Moving to Stage 2, we take that $8,781 as the starting capital for the period from March 31st to October 30th using HHIS2. The return for this period was a massive 55.75%. The math, $8,781 times 1 plus 55.75%, resulting in $13,676.41. Finally, for Stage 3, we input the starting amount of $13,676 for the period from October 31st to today, December 28th. The return was minus 6.83%. The math, $13,676 times 1 minus 6.83%, bringing our final total to $12,742.08. From these 3 steps, we can draw a conclusion. If you had simply held the underlying stocks of HHIS for the entire year, your total return would have been approximately 27.42%. The math here is the final $12,742.08 minus the initial $10,000, divided by $10,000. So, how did the actual HHIS perform? On December 28th, the share price of HHIS was $12.73, which is a 2.79% increase from its launch date price of $12.38. Additionally, It paid out a total of $2.53 in dividends per share over the year. To calculate the total return, $12.73 plus $2.53, divided by the starting price of $12.38, which gives us 23.26%. Looking at 27.42% versus 23.26%, you might think HHIS significantly underperformed the stocks. But wait, there are two crucial factors we must consider: currency exchange and dividend reinvestment. The first factor is the exchange rate. On January 16th, one CAD was worth $0.69, but by December 28th, it was $0.73. This means the US dollar depreciated significantly during this period. Since HHIS does not hedge for currency, we have to adjust our simulated stock returns for fairness. The math: the stock return of 27.42% divided by 0.73 and then multiplied by 0.69. This adjusts the underlying stock return down to 25.92%. The second factor is dividend reinvestment. Currently, the distribution yield for HHIS is 19.87%. To simulate the effect of reinvesting those dividends, we first account for the 2.79% stock price increase on our initial $10,000, giving us a base of $10,279. If we plug this into a compound interest calculator with monthly reinvestment, the result after 1 year is $12,518. This means that with dividend reinvestment, the actual return for HHIS is approximately 25.18%. Now let's compare the final results. The adjusted underlying stock return is 25.92%, while the reinvested HHIS return is 25.18%. The difference is only 0.74%. Considering the management fees of HHIS, the cost of borrowing for leverage, and the friction from rebalancing, this margin of error is completely acceptable. Of course, my calculations aren't 100% precise. It's very hard to perfectly simulate the exact percentages during rebalancing. However, this simulation proves that the HHIS covered call strategy is efficiently converting upside potential into cash flow. This backtest might not mean much to some, but as someone who is naturally skeptical of actively managed funds, I think it was necessary. I used to wonder if Harvest chose such a complex structure to hide failures in their covered call strategy, but this comparison has cleared my doubts. At least in 2025, HHIS did its job well. Covered call ETFs are often criticized not just for capped upside, but for an asymmetric risk profile, meaning if the strategy doesn't convert well, the downside risk is much larger than the potential gain. The performance of HHIS so far proves that, for now, that isn't a problem. To be clear, this video is not intended to persuade you to buy or not buy HHIS. However, in a market where every influencer seems to be full of nothing but praise for HHIS, I believe this kind of skeptical backtesting still has real value. If you found this video helpful, please like, comment, and subscribe. Thank you all for watching.